Thank you. So Justin is at WeFunder. WeFunder is one of many different platforms you can use to satisfy the Reg CF program that is part of the Jobs Act that got us to the point where we could do federally approved crowdfunding for equity. And so hopefully you can set some context. I've been putting into the chat questions. I begin with Q : so that it's easy to spot them in the chat. And if people have questions and you put questions in the chat, we'll try to address them. We'll have plenty of time for conversation later. But Justin, if you could set the context for who you are and how you got to be working at WeFunder, and then dive right into the conversation with your talk.
It's a pleasure to meet everyone. Thank you again for inviting me, John. It's a great joy in my role to be able to talk to such a wide range of different types of companies. That is probably what I enjoy most about working at WeFunder is the range of companies that we get to see. There's no kind of clear cut, stream for, WeFunder works for this type of company, but not for that type of company. And I look forward to unpacking that nuance and really giving as much insights and context as I can possibly provide. I've been with WeFunder for 2 years, and my main role is developing partnerships with organizations like SAC and working directly with founders and helping them maximize the opportunity that WeFunder provides. A little background on me. I actually started my professional career at a nonprofit called Kiva. Kiva is another crowdfunding platform that does interest-free microloans for entrepreneurs all over the world. When I was there, we were doing about $300 million of interest-free microloans all over the world every year. And I launched their US program and was out all over the country meeting entrepreneurs and helping them get their first wave and first injection of capital. Again, these were like $5,000 and $10,000 0% interest microloans, so much different scope than what I'm doing at WeFunder, but it really allowed me to meet and talk to and get under the hood of entrepreneurs and what they were building in those early phases. So was inspired by one entrepreneur that I met at Kiva, who basically said, I quit my job, I moved to Florida, I bought a boat, and I started doing boat charters. And I need a $10,000 loan so that I can expand my fleet. And I was like, wow, that's awesome. That sounds really fun. So a year later, it was almost a year to the day of that conversation where I moved to San Diego, I bought a boat and started a boat charter business myself. So I started that 4 years ago. Built it from nothing to now we have a fleet of boats. We're doing hundreds of boat charters every single summer. And, I basically took it from a place where I was captaining these cruises and taking people out and executing the day-to-day operations of the charter business. And when I got the business to a place where I could just hire out captains to run all of my boats, gave me an opportunity to look for something new. And my core team at Kiva that was in charge of launching the US program there had moved over to WeFunder, and they came on board and they were like, you want to talk to entrepreneurs all day? And I was like, sign me up. So I've been down the road myself. I used crowdfunding to raise capital for my boat business when it first launched. And I've now worked with hundreds, if not thousands, of entrepreneurs and helping them figure out how to kind of piece this all together. So the real value in my role is I've seen so many entrepreneurs utilize it in so many different ways. There's extreme creativity in how to approach a resource like this. And I hope that, we'll have ample time for Q&A to kind of flush through those specific use cases as they apply to you, as there will probably be parallels in where a lot of you are at. I'd like to start and just give a very high level, like who is WeFunder, designed for, and what does that target customer typically look like? Generally speaking, I would say the majority of companies coming to WeFunder are in that like seed to Series A funding stage. They're actively looking to raise capital And they typically follow the similar, the similar kind of pathway where it's, bootstrapping and friends and family to a seed round, to a bunch of bridges, to hopefully get to a Series A. That whole spectrum is, we can help companies across that entire spectrum. But typically, WeFunder is best utilized for companies that are kind of post friends and family. They've got traction, they've got momentum, they've got a real product, they've got real, they've got real momentum around the business, and they're out looking to raise outside capital. And the value proposition that we come to the table with is, if you're out raising capital, you can do it faster and easier by doing it on a platform like WeFunder. Now, there's one of the questions that got cycled a couple times through the intros was, does it work for B2B, or is this only a B2C? So I want to talk a little bit about kind of crowdfunding and how it's progressed over time. It's been a very interesting kind of storyline from the early days of crowdfunding with Kickstarter and Indiegogo to where it is today. It's a particularly interesting time to be having this discussion, as there are a new suite of regulations that are being rolled out by the SEC on Monday. So our entire company is on a retreat right now preparing for these new regulations. Again, we'll get into the details later. At the highest level, the cap used to be $1 million for equity crowdfunding. That was the max you could raise. Now it's being increased to 5 million. So there's an entire new kind of perspective and thought process around how can companies utilize it, and how can, the SEC is basically making it way more founder friendly to be able to take advantage of regulation crowdfunding, and WeFunder is trying to come in and maximize that opportunity. So we'll get into that later on, but it is a really exciting time, for our industry and the growth of the industry at large, and for us specifically. So I'm going to share my screen real quick. John challenged me to put a deck together, and I don't typically do decks. So we're going to see how this goes. I'm hoping for the best. John, you're a great critic, so we'll see how this goes. Can everyone see my screen? Can I just get a?
Yeah, that's working great.
Okay, great. Can you see this too? I can minimize that. There we are. Cool. So the first piece is that WeFunder is a public benefit corporation, and our mission to democratize access to capital and to make this founder friendly and to get this out to the masses is at the very core of our operation. It's something that we factor in very heavily to who we hire. Again, most of our core team came from Kiva, so we've kind of got that mission and impact piece woven into the core fabric of our leadership. But it's something that I want to start with because it is an important piece of who we are as a company. At the highest level, it's one, we believe that the people are wiser than banks or venture capitalists. We believe that everyone has the right to invest in what they believe in. We believe that helping more founders take their shot increases all of our wealth. And we believe that investing in dreams, win or lose, benefits us all. Just a really important piece as to who WeFunder is at our core. I would highly suggest reading our Public Benefit Corporation Impact Report. We released this a couple weeks ago. We're very, very proud of it. We've been doing this since 2012. We were co-authors of the regulation crowdfunding piece that was included in the Jobs Act. We were the first to market. Right now, we have 41% market share of equity crowdfunding, and it's something that we feel really, really passionate about. We really believe in what we're building here, both on the founder side and the investor side. Now, WeFunder is fundamentally a marketplace, For the founders, we want to make it easier and faster for you to be able to raise capital. And on the investor side, we want to be able to give investors of all types, of all shapes, of all sizes, rich, poor, you know, we want to give them the ability to invest in this capacity. So we feel really proud to have, we're going to hit 1 million investors next week on our platform, which is a stat that we've been very anxiously excited to announce. So it's been it's been almost a 10-year road to get to where we are now, but the mission is a critical piece of the overall kind of operation. I want to go through a couple examples. As we said before, I'm going to give an example of a consumer-facing brand and of a B2B company that's currently fundraising on our website. This is Pit Liquor. They've done $1 million in sales. They sell a bunch of different kind of grooming products for men, and they've raised $450,000 over the past couple of months. The dynamics of this campaign are they raised a seed round. They're not quite to a place where they can raise a Series A, and they're looking at equity crowdfunding as a bridge. Now, this bridge is going to allow them to, their hope is to go from 1 to 5 million. They're looking at 5x growth over the next 2 years. And they're hoping that this injection of capital helps them get there. The real benefit for a brand like this is with $1 million in sales, I believe their average transaction is $35. They're doing a lot of transactions every single day. So with each transaction, there's going to be naturally, an email engagement series. There's a direct connection between the customer and the brand, and they have the ability to highlight their WeFunder campaign to that audience of customers. So every single customer, once they check out, they get an email saying, hey, go check out our WeFunder campaign. And it's a really powerful way to take a customer and turn them into an investor. And if you can do that, the chance that that is going to be one of your best customers is very, very high. If you can do that in the hundreds or in the thousands, that's a really unique opportunity. On the flip side, you've got new investors that are finding out about their campaign coming from WeFunder that are now investing in the company, and now Pit Liquor can market directly to them and convert investors into customers. So you've kind of got this two-way flow where it's you're converting your customers into investors, you're connecting your investors to be customers, and building this foundation of stakeholders that can be a powerful force behind the brand. Especially for something like this, it's like, hey, this is perfect for birthdays and holidays and presents. It's like that ability to kind of like force market through this brand, through this army of ambassadors is really powerful. Now, let's use Kickstarter and Indiegogo as a reference point here, because I think it's important. Generally, and this is really where crowdfunding built its reputation. With a platform like Kickstarter or Indiegogo, Pit Liquor could go on there and basically they act as an exchange of goods. If you give me $100, we'll give you a Pit Liquor, variety pack. And the ability for them to kind of like execute a good campaign, it's essentially just a pre-sale forum where it's like you're getting a ton of customers coming in to invest or to buy product, and it's a marketplace of that variety. You're probably not going to get a bunch of super big checks and a bunch of, you're not going to get $10,000, $20,000 checks in that framework. The beauty of equity crowdfunding is they're investing equity in the company. The product isn't as relevant, and it's not something that they really need to lean into. If you look at this here, they've raised $450,000 from 541 investors, which is an average investment of $830. That's really the key difference, is what you're selling. Are you selling product or are you selling equity? If you're selling equity, you're going to see the average the average investment be much higher through an equity crowdfund than you would through a marketplace like Kickstarter or Indiegogo. And that's the big differentiator. The industry itself on the rewards-based crowdfunding, Indiegogo and Kickstarter, has been going down every year because I believe it's becoming more and more narrow as to who it's a good fit for. You have to have a consumer product that's at the right price point, and it needs to have a cool, sexy technology aspect to it. That's your bread and butter on those platforms, which is very limiting in terms of the overall scope in just what we saw today from all the introductions. On a platform like WeFunder, they're getting $10,000, $20,000, $30,000 investors that are coming in and engaging in that way, which presents a unique opportunity. Shift gears to a B2B company. This is a marketing company. It's ad tech. They've got an amazing solution. Bootstrapped this company from the start to where they are today. They've got incredible engagement metrics. They're really shown that they've got pickup, they've got momentum, they've got traction, and they're using WeFunder to raise their seed round, aiming for a $500,000 seed round. They've been live for the past couple of weeks. Now, a company like Worth doesn't have that opportunity like Pit Liquor might have in engaging with their customers and trying to get them to invest. That's just not an available pool to fish out of for new investors. The real benefit here is they've got amazing engagement metrics. They're out talking to angels anyway, and they might say, hey, we have a $25,000 minimum check size to be able to invest in Worth. Well, now on WeFunder, there's no minimum check size. So where you might get a no at 25,000, you could get a yes with those investors coming in at 5 or 10,000 to kind of like, get your foot in the door, tease it out. If you can get a lot of those investors that you're already talking to convert at a lower dollar amount, you can engage with those folks in a really compelling way. I think the bigger piece for me on why I'm bullish on B2B companies fundraising on a platform like WeFunder is generally the type of investor we have are investors that want to get a 20x, a 30x, a 50x return on their investments. A lot of times those are the types of investments that they're proactively looking for. Now, for a company like Pit Liquor, it might be a harder pathway for an investor to see, a 20x return on their investment. Whereas with something like Worth, it's a scalable enterprise technology. It's a B2B software company. The traction that we typically see for B2B companies from WeFunder's audience, folks that are traditionally looking at, that are more attractive to like sexy technology that's able to scale B2B enterprise, those are generally the most attractive angel investments. If you look at the angel, the angel ecosystem all over the country. And typically you'll see a higher average coming from WeFunder's audience on these types of campaigns. So on average, on an average campaign on WeFunder, 40% of the total raise is being generated from WeFunder's audience. 60% of the raise is being generated from the founder's audience. Generally, it's a little bit more friendly towards those enterprise B2B types of companies, and a little bit lighter on those consumer products or campaigns that are kind of organized around community. So it obviously depends. Every company has a different mixed bag of assets, but generally speaking, you're seeing more momentum and traction from the investor community on B2B companies, and then an attractive outlet to engage with customers and engage in community building activities for the B2C companies, which tend to be the engine of the fundraise. So these are two very tangible examples. You can go to either of their WeFunder pages right now and dig a little bit deeper into what they're doing. But both great campaigns. I've been stoked to work with both. Both have a very different kind of approach and strategic kind of construction in terms of how they've been able to execute on their raise. Moving forward, the marketing piece, I believe, is just as relevant for all companies. WeFunder presents a very user-friendly way to tell your story. You have full control over the narrative. You can showcase the momentum and generate FOMO. You have the ability to kind of construct this core message that is relevant for anyone that might be interested in investing. Those are investors in your network, your second degree network, your customers, utilizing different channels like paid media to drive a campaign. You have full control over a narrative talking about your business and why there's so much optimism and confidence behind what you're building. It's a really unique way to have an asset that tells that story in a format that you have full control over. The second is that we streamline the fundraising process. I think this is probably the biggest piece, the biggest value that WeFunder provides is that you're able to raise from both accredited and non-accredited investors. There's no minimum, so anybody can come in at the level that they're comfortable with. It's an open door, anybody can walk through. And it's a very consistent process, and the investor user experience is awesome. Being able to invest in a private company by using a credit card, or you can do a ACH transfer, or you can mail a check, or you could use your IRA. You know, you have 5 or 6 different ways. So it's just so easy for an investor to come in, make an investment with the payment option they feel the most confident in, and then WeFunder manages all of the investment contracts and all of the operations and mechanics around that raise. The last piece is community. You know, we have over 900,000 investors, should be 1 million by next week. Again, who fund 40% of these campaigns on average. And whether it's B2B or B2C, you're building a community of stakeholders. These are investors that are engaged and committed to your success. And your ability to access this group for follow-on funding and kind of bring them on that journey, it becomes a very powerful stakeholder for the business. Now, when we look at angels and VCs, a lot of times people point to the value that they can bring in making connections and giving advice and providing expertise. The WeFunder investor base provides a different value. They can do the advice and connections, but generally speaking, it's just this is a powerful community behind the operation that's going to do follow-on funding that you have immediate connections to, that you can give asks to this group of people that are engaged with what you're building. And generally that's in the hundreds, if not thousands, which is a big group of people that are kind of fueling the momentum of the business. So I think for every company, these core kind of tenets around marketing present a very powerful opportunity for founders to leverage. The other piece of the puzzle is the back end kind of logistics and mechanics, the operations. We do all of the SEC filings and compliance, making sure that everything is streamlined. We manage every single investor contract. We have one entity on the cap table, plus a Reg D sidecar. We'll get into those mechanics a little bit later. And you can raise the valuation if your business is leveled up. You can pull money periodically as you're raising capital. There's just a lot of flexibility, and the back end mechanics are kind of present WeFunder in a way where it's like it's a little bit of upfront work to nail all of these pieces down, getting the term sheet right. You need reviewed financials. We have the investment contracts All of that is kind of like upfront work early on. Once that's in place, all you need to focus on are we telling the right story, and are we getting it in front of the right people? And then it's just like, okay, we've got this one place where we can send anybody to come in and invest. And all of the mechanics and all of the legal stuff is managed by WeFunder, which makes it a very easy thing to just kind of put in your back pocket, where it's like, I have this, I'm out having conversations, talking to people, any of them could be a prospective investor, and I can send any of them to this kind of one central place and trust that WeFunder is going to manage all of the back end mechanics. It's something that's flagged by founders constantly in terms of, it was just so easy to just focus on getting people to the page and focus on telling the right story. In terms of momentum, over the course of our history, we've now raised over 250 million. We have 5 billion plus in follow-on financing. We've created over 15,000 jobs, over 1,500 campaigns, almost 1 million investors, with a median investment of 250 and an average investment of $1,000. This year specifically, it's really ramped up. We've seen 5x growth from Q4 to 2019 to Q4 2020. That momentum has been just accelerating at a crazy pace in January and February. Now going into these new regulations, we're just really, really excited about all of the activity that's happening around our industry. In 2020, we invested 87 million, and we have over 40% market share of the major players that are in the equity crowdfunding place. Again, with the new SEC regulations and the $5 million cap increase, it presents very unique opportunities for founders to utilize crowdfunding in even more creative ways. Now, the one thing that I think influenced our growth more than anything else was cap table construction. Prior to 2020, every single investor, whether they were $100, $1,000, $10,000, every single investor went on your cap table. That was deeply unattractive to founders. They did not like that. I don't want a $100 investor on my cap table. This is going to jeopardize follow-on financing. In 2020, we came up with a solution that allowed companies to bring a lead investor, and that lead investor was the representative proxy for all of the investors that came in through WeFunder. So all of the investments are rolled into an SPV, and it shows as one line on the cap table. And that one line is voted, pro rata rights, voting rights, information rights, any kind of like signatures that you need to get, all of those are being managed by one lead investor that you select. When we put that in place, we just saw the appeal of equity crowdfunding explode. And we feel that's been a big driver of our growth over the past 15 months. Again, with these new SEC regulations that are going into effect, they make it even more friendly for founders to be able to fundraise. I'll talk about the new regulations in two core benefits. The first is and again, these go into effect on Monday, March 15th. So we're preparing all of our operational processes around these new regulations that are coming out. The two pieces is, one, prior to March 15th, you need to defile the Form C and get all of your compliance and legal stuff done before you could fundraise $1. With the new system, companies can launch their crowdfunding campaign and do all of the legal and financial stuff in parallel, which means you can put a campaign page together and start bringing in investors and do the legal stuff in parallel, which just streamlines the process and allows you to tease it out. If it doesn't work, you can just scratch it, not do the legal stuff and move on. If it's working really well, then you're kind of doing both at the same time and putting it in place, just making it far more efficient for founders to be able to tease out if this is a good option. So that goes into effect on Monday, where founders can just create a profile and start fundraising, within within a few hours, you can kind of get this ball rolling, which is something we're really, really excited about. The other piece is the $5 million cap increase. Now, with crowdfunding in the past, it's been viewed in a very narrow way, where it's like, we want to raise a $700,000 bridge to get to our Series A in 2021. We don't want to do our Series A in COVID. I had 1,000 of those conversations last year. With this new $5 million cap increase, what you can do is raise that $700,000 bridge, then pause the campaign, close out all of those investors, increase your valuation, and continue to build on that 700 in subsequent rounds. So now you can have 3, 4, 5 different periods where you continue to build on what you've already raised. So you could do $250,000 initially, into $500,000 in later 2021, into a $2 million campaign in 2022, and you have $5 million of runway to kind of that you can utilize in series. So the base that you're building, it's so fluid where you can just hit go, and there's just absolute flexibility where you can pull money on a recurring basis from the campaign. You can increase the valuation at any point, and you have ultimate flexibility in that you always have this in your back pocket with a $5 million runway, which we feel is a really powerful, flexible way for founders to be able to utilize equity crowdfunding. In terms of best practices, from a compliance standpoint, we only have the ability to work with companies that have a U.S. incorporation. They need to be an LLC or a C Corp. And to launch an equity crowdfunding campaign, you do need 2019, 2020 reviewed financials from an independent CPA. That generally costs like $1,500. It's not super hard, but for some businesses, they just don't have their stuff together. So it can be that process can drag on. So those are kind of legal and compliance pieces that you need to have in consideration. The second is articulating your pitch, creating the campaign page. You need a video. So you should have like absolute conviction and kind of intention around this is the investment opportunity. This is where we're at. This is why it makes sense. That's a very important piece of the equation. This is a marketing campaign. It is part of the construction. The third is aligning on terms with early investors. We do give founders the ability to set their terms, but generally speaking, you need investors from your first degree network to kind of get the ball rolling. Generally, you're not going to see a ton of momentum and exposure from WeFunders community early on in the campaign, but as you build up more and more momentum, those opportunities for exposure and impressions from WeFunders community will grow. So that's an important piece of it. And then the outreach strategies to the extended audience. This is especially relevant for consumer-facing products. Having the right strategy and execution around how do we convert our customers to investors. It's not the easiest thing in the world, and there is a lot of work to go to think through how do we best deliver on this execution from these customers that love what we're doing to folks that are investing in the business. So those are the kind of considerations in thinking through, like, okay, do we want to do an equity crowdfunding campaign? This isn't just like post a profile and watch the money roll in. Those shouldn't be your expectations going in. And then for more information, our FAQ is probably the best place to start. That has all of the specific information for both investors and founders, lead investors. All of those dynamics are cleanly outlined in our FAQ. And then starting Monday, you can just launch a campaign on your own. You just go to wefunder.com/raise, put a campaign page together, start inviting investors. And then as you start to build momentum, we'll put all the legal and compliance stuff in place in partnership with you. So those are the two most relevant links. All right, John, how did I do with the deck?
You did great with the deck, although I have to tell you that since this is a sales conversation, that faces and colors make a difference and words are distracting. So the more you put in pictures and faces, that's a win. But nonetheless, that was good. I want to press on a particular issue because you said people could raise up to 5 million. And I think it's 5 million per year or 12-month period. And so I think you
that is
could
not
raise,
accurate.
I just read the SEC page.
That's if you close a campaign. So if you were to close a campaign, you would be subject to that 12-month window. There isn't a 12-month restriction in how long you can have one active campaign open. So as opposed to closing it, you can just pause it and then reactivate it at a later date. And then there's no time limitations there. So we're not, basically it's like, if you are ever going to explore this in the future after doing your first raise, you shouldn't close, you should just pause. So there's a nuance there.
Unless you decide to raise $5 million, close it, open a new one 6 months later for another 5 million. So you could continually raise with this. It's not limited to a one-time thing. That's the point I wanted to make. There were several questions that came through.
Perfect.
I think it would be worthwhile going through. I think Francis wants to understand, how does someone in Canada do this? And needs to understand more about that. I think people would like to hear more about what a SPV is and what that really means. If you could go into those.
Yeah, so we do work with founders that are based internationally, but you have to have a US incorporated LLC or C Corp. It's a little more complex logistically because, then you're setting up a C Corp that's a shell corporation. And then, how does the investor kind of connect back to the parent company? There's a little bit more legal work that goes into making this legal structure work for international companies. But the high level answer is, if you have a US incorporation, LLC or C Corp, you're able to raise.
So you go to Stripe Atlas and then you form an entity, and then that entity can take investment.
Correct. To build on that, the question around investors internationally, we do not accept investments from Canadian investors. We are able to accept investments from any other country. So Canada is the only country that we do not accept investments from, which might make it tough if you're based in Canada.
Right.
That's not we didn't choose that. That you can blame the Canadian government for that one.
So Anu asks, what's the advantage of not closing the round but pausing it instead? What do you get out of that?
Well, you can just hit a button and say keep fundraising, and then you're building off the base that you've already had. So if you raise 700,000 and you close your campaign, you have to file a new Form C. There's a bunch of regulations that are part of the SEC that make it pretty unfriendly for founders to do repeat campaigns. It's just a way more flexible and friendly option from a work standpoint, both for us and for the founder. So it just doesn't make any sense to close unless you're ready to move on to VCs and you're way past the equity crowdfunding kind of category, which would be companies going to a series B.
But there's no reason why you couldn't start a new one if you wanted. You'd just be starting a new pile of people.
Exactly.
Right. And so,
also a lot of times you see a 30% jump from what you raised in the first round from existing investors. So you already have a 30% that's going to come in those first 2 weeks as a result of, assuming you did a good job growing the business and keeping your investors engaged. But the ability to just hit go again, then send an email and have 30% of what you previously raised just there in a flash. Those subsequent rounds are so easy. It's kind of a ground and pound operation in that first wave. And then it's just oh, we have all these people, we can engage with them and give them quarterly updates and treat them like an actual investor. And then they'll be with us for the long term.
Right. I see Steve asking about this question around pre-revenue or early revenue funded. Does that Does that make a difference whether they have revenue or not?
Yes, it definitely does. You know, the stronger the investment proposition, the more kind of traction you're likely going to get. Now, pre-revenue doesn't always mean that you haven't made a lot of progress. That's just the reality for a lot of companies. It could be user growth, but I think it is important to have what is the relevant metric that indicates momentum for a company like yours, and to what extent can you articulate that and get people to buy in on it. You know, like the more momentum you have, the better the investment opportunity is, the better the price of the terms, the more investments you're going to get from WeFunders community. You know, for those pre-revenue, pre-seed, friends and family types of companies, WeFunders still a viable option in that we can streamline all the operations and all the back end kind of compliance stuff and make it really easy for you to do a friends and family round. But I wouldn't go into it with the expectation that you're going to get 40% of your raise from WeFunders network. For companies in that phase, it might be 10% from WeFunder, 90% from your own efforts. But again, as you build it and use that money and actually grow the business, there will be more and more of those doors that open that connect you to different audiences of investors, just like how it works today without crowdfunding. That's just like, you know, it parallels the fundraising path for companies in very similar capacities, that being one.
We've got people asking questions about, can I do a Reg D, 506C, and a Reg CF at the same time? Can you dive into that a little bit?
Yeah, so absolutely, totally cool to have both in parallel. One thing that I didn't mention is our business model and how it works. So we charge a 7.5% flat fee for all investments that come in through WeFunder, with the exception of any $25,000 plus checks that come in. If you bring 25K plus investments to WeFunder, they will come in with no fees, and we will open up a sidecar Reg D for free and move them from the SPV to the Reg D. So a $25,000 investor may say, I don't want representation from the lead. I want to be a standalone line on the cap table through a traditional Reg D. So you've got the CF that basically acts as a holding cell for all of the smaller dollar investors, with the sidecar Reg D in parallel for any $25,000 plus investments that come in from accredited investors in your network. And we manage the cap table and both of those in parallel on WeFunder. That doesn't mean you can't also go do your Reg D and secure capital elsewhere. But you know, that's really the design, is to make it as founder friendly and flexible as possible. And the Reg D piece, waiving the fees and putting them as a standalone on the cap table is something that founders really value. John, I lost your audio.
Yeah, thanks. I got on mute. So Reg D and all of the Reg CF stuff is essentially front end stuff that you have to do to define the offering. But when you do the investment in the company, there's a bunch of different kinds of deal terms. Could you dive in a little bit about what kind of deal terms you could have with the company?
Sorry, John, could you repeat that? I missed it on the audio again.
Can you do like a SAFE or a convertible note or a straight equity or a revenue redemption? What are the deal terms that are possible?
All of the above. Where we span the entire spectrum. Most companies choose to do a SAFE or a convertible note, and we've got just templated contracts where you can put in your valuation caps and your discounts, and you know, it's a plug and play operation. It's very easy. You can do it. You just use our template and plug in your own numbers. But we also do priced rounds for companies that are at that Series A plus kind of stage. We also have debt contracts. We've got hybrid contracts. So you can connect with one of our lawyers or use one of your lawyers to come up with a custom contract, and we will basically be happy to host for any different type of investment contract. But 80% are safes or convertible notes.
Yeah, and let me say it out loud that in the context of Seattle, I'm not a fan of safes at all. But Brian asks if I raise $1 million, can you walk through what the costs are, the legal and accounting costs, all of the total? I have this company, I want to raise $1 million. How much money do I have to allocate for the process, including
so there's
lawyers and accountants and all that work?
Yeah, so reviewed financials, we require 2019, 2020 reviewed financials. For most companies, that's like between $1,500 and $3,000, depending on kind of how complex and how organized your stuff is already. And that's what you pay to an independent CPA. We've got good referrals, but that's really the only cost to launch are those, or it's not even a cost to launch, it's a cost to file the Form C. You can launch, you can launch without anything, as of Monday, but 1,500 to 3,000 is a realistic expectation for the reviewed financials, assuming you just use one of our contracts, which most founders do. There's no cost there, but you can obviously pay a lawyer to come up with a contract. But there's no cost to launch. We just have a flat 7.5% that's taken on all investments under 25K. That is our business model. Now, some founders choose to work with a marketing partner. We have different agency partners that we've worked with that understand regulation crowdfunding. They've got investor lists. They do paid media. They do videos. So you have the option to go work with a media partner that's, and degrees to which you want to work with a marketing partner. You could just say, here are the keys, go do it for me. I'm going to pay you to run my whole campaign. I don't really want to be involved. Doesn't work that well, but that is like one option on the extreme end of the spectrum. A lot of campaigns are just like, hey, we'd love to tap into your investor list. Here's $10,000 for paid ads to those investors to drive impressions and visibility and exposure to my page. So that marketing cost is totally optional. We have some founders that are investing heavily in that. We have some that aren't investing at all. So that's the variable cost. And the construction of kind of media and agency work is it really depends on the company and kind of what they're working with.
So I don't have to hire a lawyer because I can use your templates. I do $3,000 to get my accounting done by someone, and I give you 7.5%. So if I raise 100,000, that's $7,500. If I raise $1 million, that's $75,000.
Correct.
That I pay, and there's no back end carries, and there's no upfront fees or costs to be involved. It's whatever you raise, 7%, and then we're done.
Correct.
Right.
Correct.
And so then if I keep hitting the restart button, it's still just 7.5%. So I raised 100,000, then I raised 500,000, then I raised 5 million, 7.5%.
And then like at some point in the year, you need like your new financials for 2021 to be able to extend the campaign another 12 months. So this whole construct of this like ever-going campaign, I always have this option available to me, is really just contingent on updated financials on a rolling basis. That's once a year. So I guess that would be an ongoing cost to keeping a campaign open. I also saw another question about the campaign being opened and how terms work. So let's say you raise that, you raise 600,000 on a 5 million valuation. You don't want to offer any more equity. You close out all 600,000 and all of those investors. You don't have anybody in limbo. You have every investor has been closed out at that point. Then we file a material amendment to increase the valuation, and then you can choose to fundraise on that new suite of terms at any point in the future. There's just a 30-day window that we execute that transition.
And Brian's asking another question.
Yeah, very, very, very relevant that reviewed financials are very different than audited financials. Audited financials are not necessary on equity crowdfund. 1,500 to 3,000 is typically what you see for reviewed financials. Our lawyer is not included in that 7.5% if you use our standard contracts. If you want to work with one of our lawyers on a custom contract, you can pay them to do so.
So I think Brian is confused a little bit about the terms of whether it's already equity or whether it's a convertible note. So most of your current stuff is either doing a SAFE or a convertible note already.
Correct.
And so that means that it's not equity at that point, but you can do a priced round if you want to, so long as you have a basis for valuation, right? So you have to be able to convince at least a lead investor what your valuation should be. And then what Brian said is correct, right?
Right, exactly. That's 100% right. And, setting the valuation is extremely important. Obviously, like, safes aren't as investor friendly. So you might want to go with a note because we know that investors generally like convertible notes better than safes. Because you can set it yourself, we do find founders that are over bullish on how they value their company. I think it's best practice. It really depends on how much you want to raise. Because if you want to raise 100,000, then it's like, okay, it's on you to go construct that 100,000. And if you have investors in your network that are willing to come in at that valuation, that's great. If you're looking to raise $1 million and you're coming to the table with 300,000 from investors in your community, that's still a $700,000 gap. And those terms become a lot more important to being able to kind of secure that buffer. So that 300,000 that comes in early will likely come from 25K, 50K, 100K checks from angels in your network that are already in the mix. Chances are they are talking about terms. That is something that they care about, especially at those higher investment levels. So that's why we highly suggest making sure there's alignment with the lead investor, but also just not just the lead investor, all of those angels in your network that you're planning to cycle in here, because your intention of raising $1 million is, hey, I might be able to raise 300 on my own. I'm hoping that WeFunder can help me kind of patch together another 700K on top of it. And if the deal's not priced right, it's not gonna get the pickup that you're probably hoping for.
Right. So Alex is suggesting that a 409A evaluation to set the valuation might be a useful thing. Let me say that at early stages, I don't think 409As are useful at all. How do you see 409As?
I don't know what a 409A is, and I probably should. So that's some homework for me. I do, in my role at WeFunder is really around the fundraising campaign strategy, the marketing side of the business, connecting you to relevant partners and helping you raise the capital. We have a separate team at WeFunder that specifically emphasizes and focuses on the legal and the compliance and making sure that all of those ducks are in a row. I just don't have a ton of visibility into the nuanced legal dynamics on that end.
So a 409A is an option to go get a third party to give you an arm's length review on your valuation, which is usually a function of both momentum and revenue, both of which are gnarly at the beginning. So you get really bad numbers from 401A.
Yeah, for sure. I would think that would be more relevant for a priced round going into institutionals, and it's harder to kind of align on a right valuation when you're pre-launch. The earlier stage you are, the harder it is to price in that respect.
Right. I see Jason asking the question about how do the investor incentives work on a campaign?
Yeah. I mean, the incentive is to buy equity in the company. First and foremost, that's what you're selling. If you could elaborate on that a little bit more, we do have perks, you can offer perks I've seen some really cool, interesting application of perks. But I don't think perks, it's not like t-shirts and swag. It's like, hey, if you've got a B2B product, that's for SMBs and you have 100, hundreds or thousands of SMBs using your software, you might have a perk that's like, hey, you're already using our software. If you invest $1,000, we'll lower our fees from 5% to 3%, on any transactions on our platform. So there's like a business reason for them to incorporate perks so they can convert, like their customers to be investors. So you see that in some way, but the real incentive is like, hey, we've got all this momentum. Look at all of these assets. Like, we're trying to raise capital and get to the next level. That's why you invest.
Can you talk a little bit about how we would structure revenue redemption kind of mechanics for a company that really will never take a Series A?
Right.
But $5 million in revenue redemption might be a perfect solution for them.
Yeah, we see so much creativity there. I think it's a really valuable way to approach a raise for a company that doesn't follow that traditional pathway. I like the equity plus, plus revenue. I saw a really interesting contract from a brewery where it was basically principal plus 50%. On a profit sharing model where 10% of profits went to pay back investors until they got principal plus 50%. In addition, they bought equity. They had equity in the brewery. So there was kind of a debt component as well as an equity component kind of woven together. The reason he did it in that way is he was out talking to $200,000, $300,000 investors, and they wanted both as part of the construction of the deal. So he worked with one of our lawyers to put that specific kind of model in place. It really depends on kind of what your business model is. Our boilerplate contract around revenue redemption would be revenue share agreements, where it's basically you get a 2x on 5% of revenues. And it's a very kind of simple construction. There's another generally you're seeing this more for like Main Street businesses, which was a big part of our portfolio for a long time on WeFunder, and you just saw the revenue share model just be something that they felt could convert more investors, both from their own efforts and from our community. So again, the point of terms is constructing terms to drive the highest level of investment, and it's an art more than it is a science. Your ability to go out and do your due diligence around what might unlock these bigger checks from my network to come into this deal, that's generally going to be a signal. If you're getting a lot of positive feedback and signals from your network, it will likely translate to WeFunder's investors and how we look at the deal. But it doesn't work if you're like, oh, well, I'll just bring the first 100,000 with a 100K check from my grandma. She doesn't care. I raised the first 100K. Now WeFunder, go do your thing. You do see that sometimes, and it's just like, that's not how investing works in the real world or on WeFunder. It's, WeFunder is just like a digital kind of translation of what's actually happening out in the world. We just have like this huge visibility net as a result of having 1 million investors and cycling $15 million a week on our platform.
So Keenan is asking about your progress with social impact investments.
Yeah, it's a huge part of who we are. Again, I led with that in my presentation. It's something we actively look for. For me personally, I have a pretty broad spectrum of impact. I look at like rural America, I look at women, I look at minorities, I look at, kind of, opportunities to put money where like money is harder to access, as my personal kind of designation of social impact. I think social impact is a little bit tough because it's subjective to everyone, but I think that PBCs, if you want to kind of like stereotype it and throw it through a traditional track, it's like public benefit corporations love WeFunder, and I think we do really well, just as a byproduct of us being a PBC and, having those types of investments and building that type of community. It's a very explicit thing for us, on the impact piece. Again, our core leadership team, all came from Kiva. So that was, that's a big kind of common thread in the ethos of the company.
So
I also saw a question earlier about like, how do we compare to Start Engine and Republic and the other main competitors? I think that's a big one. We're a public benefit corporation that's specifically focused around founders. I think our pricing model is a lot more friendly in that it's just a flat percentage. You go talk to some of our competitors and it's like, well, it costs $2,000 if you want to switch your valuation. And if you want to change this, it's $500 for our team to go in and like tweak some part of your profile. And if you want, and you end up spending a lot more money in these like random $500, $2,000 things throughout the campaign versus us, it's just flat consistently. I think that's a big differentiator. The legal construction with the SPV and the lead investor is different on WeFunder than on other platforms. We think that's probably the strongest appeal for serious founders that are going through and looking at a Series A and they don't want an equity crowd fund to jeopardize that in any way. I think WeFunder has the cleanest and most crisp construction in terms of cap table dynamics versus a crowd safe. You should really do your due diligence in how those other platforms go about it. We feel that ours is by far the strongest across the competitors. And, the other piece is just like, there is value in being the biggest, with 41% market share and, 30 to 40% above our next competitor any given week, any given month in terms of dollars raised. There's just more investors, there's more activity, there's more investments. And, with every company that we launch, they're bringing a bunch of new investors into the mix. So we have a really strong team that's focused around go find great founders and go engage with the investors that they bring in and get them to go from an investment to someone they know to, that second, third, fourth investment. And I think we've done a better job at kind of constructing that. And it's kind of like the proof is in the pudding. If you go to a website called King's Crowd. King's Crowd is an independent equity crowdfunding kind of like news source that reports across all the different platforms and showcases kind of how much has been raised on an ongoing basis. The last piece is just like the investor user experience we feel is superior on WeFunder. If you go make a $100 investment on Start Engine, Republic, and WeFunder, I think you'll find that ours is the cleanest. And obviously, like, the ease of use for an investor to make an investment in your company is highly relevant. So I think those are all like big points of differentiation from our perspective.
So if we put a pin on a specific issue, let's, from evidence that we see with other kinds of companies, they suddenly become less relevant and disappear. So let's suppose that you have this investment and then WeFunder disappears overnight. What happens to that investment, right? You've got 1,000 investors, they're in an SPV. How does that cap table process link back and forth between the investors and the company after WeFunder decides to become something else?
Most founders just use Carta as their cap table management. They get one big zip file with all of the relevant contracts and dynamics from us, and it gets kind of like handed off to the Cartas of the world. We also have a partnership with Savvy Legal, another company that kind of helps with investor engagement and relations. But like when you close a campaign, we close out all of the investments, figure out where every single penny currently lives, send you the final tranche, and then send you all of the contracts associated with that. And that's something that you manage offline.
Cool. Are there other questions that people want to ask, or anybody want to just come on and ask a question?
Hey, this is Jeff Zika. Justin, check your private messages. I just sent you a message regarding the WeFunder emails that are getting sent out. You might want to
I already responded. Thank you.
Okay.
Oh, there's got to be more questions. Come on now. Got like 50 people here. Let's go.
Yeah, this is Ken Allgood with Health Flow. Are you seeing, what sort of investment are you seeing on your platform around health-centric solutions, whether it's health IT or wellness solutions, that type of stuff?
A lot. I would say like 80% of our portfolio maybe is tech. So it's just like, there's a lot of health tech, a lot of med tech, a lot of, we have every little category of tech. I think the best place to kind of flush that out is to just go to the Explore tab on our website. That lists the 200 or so campaigns that are actively running. And you can just get a feel for like, oh, these are the different types of campaigns, and this is kind of how well they're doing. You can reach out to those founders and talk to them about their experience. That's probably the best route to kind of get a feel for like, how successful have kind of like-minded companies in my industry performed, through this portal. And I can also give insight there. If you hit me up, I can connect you to like specific campaigns that align with specifically what you're doing.
Okay, awesome. Thank you. I will.
Yeah, for sure.
Have any of the companies that started early in WeFunder exited? And are there any good stories to tell there?
Yeah, we have a ton of good stories. I personally love this most recent question of WeFunder's relationship with other We companies. I don't know what that means, but I really like that question. I don't know of any other We companies that we have an immediate connection to. It's just WeFunder from my perspective. Yeah, no, WeWork is another company in the world. Anywho, the best resource there, John, is to go to our results page. It's wefunder.com/results. We hired a team earlier this year to like focus on the like post WeFunder campaign dynamics and kind of what's actually happening in practice, for follow-on financing. We're very proud of the $5 billion plus that's been invested across our portfolio in follow-on financing rounds. And we have had some really big wins. The caveat there is the Jobs Act and regulation crowdfunding and accepting investments from unaccredited investors and doing all of this went into effect in 2017. When they went into effect, the cap table thing was a big issue. And it was like, great companies weren't looking at WeFunder because of the cap table constraints. So you're looking at a really short window of like Reg CF campaigns. It's like, it wasn't until March of last year that we got the cap table thing finally nailed down. And then we saw our business explode. But it's been too short of a window to say like, look at all of these winners over the past year. With that said, back in 2012, from 2012 to 2017, we were doing strictly Reg Ds with accredited investors because we could take all of the investments and put them into an SPV and operate them the way the rest of the angel investing world works. And we just had tons of winners, from that time period, focusing on Reg Ds. We came out of Y Combinator. It's a big influence on how we do our business, and it's a huge stream of deal flow for our platform. We've got a couple that are live right now. So with with the YC connections, you do have a bunch of unicorns, but I'm seeing practically a lot of the campaigns that I worked on in 2020 were coming to me saying, COVID's here. I don't want to raise a Series A. I just want this to build a bridge to get me into 2021 where I'm going to go raise my Series A. That really was like probably the most common conversation I had with founders looking at WeFunder. And you're seeing them go and raise their Series A now. I've got plenty of examples of companies that have gone through, raised 5, 10, 15 million in an institutional round post equity crowdfund.
So I see a question here about what's the experience of the average $250 investor?
I think it's just like, you know, $250 is kind of what I can afford to invest. You know, I don't have a ton of money. I'm not super rich. So I treat it just like I would if I was rich. It's just like I can't invest as much. I do think that there is like an expectation that like as an investor, you don't have a direct line to the CEO. You can't just call him and ask him a bunch of questions. I think founders do a really good job of setting expectations. And it's like, hey, we're going to do a quarterly update and a quarterly update packaged with a webinar for an open Q&A for all of our investors who came in through this round. You know, we're very intent to kind of coach you in the right way on how to manage that big base of investors. And it's really not more complicated than that, where it's like, hey, as soon as they make an investment, send them an email series, say thank you, get a survey to figure out where they're coming from, and then set expectations on what they can expect as an investor. That's really, I think, the investor expectations set by the founder are the best way to kind of handle that. With that said, especially if you're a consumer facing brand and they can participate in your product as a customer, I think it's an awesome opportunity to be like, buy our stuff, you know, like engage in our business and hard sell them in that capacity. But that communication and that cadence and those calls to actions and those expectations are, you know, managed by you. I have some founders that are like, hey, I'll get on the phone with any $250 investor. I want to know who they are. I want to know their situation. I want to know why they invested. Like, I'll talk to anybody. And a lot of times you can get someone from $250 to $5,000, you know, with a 30-minute phone call if that engagement is there. Now, for a lot of founders, that doesn't make sense. They're getting, you know, 100 investors a month, and they don't have that capacity. But a lot of times for early stage companies that are kind of, you know, it's a ground and pound. It's like, I'll talk to anybody. You know, this is a rinse and repeat for me in terms of, you know, squeezing out as much as I possibly can. So again, those levels of engagement with investors and the expectations and experience that they have are very controlled by you.
So Keenan wants to know a little bit about, Steve wants to know about doing stuff. Steve, go ahead.
Yeah, real quick, Justin, thanks for all this, by the way. And like I say, you're in a very dynamic, fast-changing industry. Question for you, two things. For those people that don't have a lot of experience raising, you know, serious levels of funds, are there ways to help get personalized support to strategize themselves? I know several companies that help people like run Kickstarter, and they take a good hunk of money, but are there similar type of companies for equity crowdfunding, or is there a good way to have someone work with someone who's a little more knowledge so that they don't feel quite like I'm a babe in the woods and I don't know what I'm doing here, to figure out how to work with you? And the second question is, what's the downside? You know, now that the cap is raised and you don't have to put the $3K up front to get your but your specialized accounting information, what's the downside to just launching a WeFunder?
Yeah, for sure.
Sorry, it was two questions. First question is, totally. How do we get the strategy? Because your FAQs, by the way, are really, really good. For those people who haven't looked, the WeFunder FAQs are really, really good. But for each personalized situation, there's a whole strategic, you know, whole strategy has to be developed. How do you do that?
Yeah. So we've got different partners on a spectrum. You know, we've got a couple that are full service. I'll do everything. You need a video, you need investor engagement, you want us to write you updates, you want us to orchestrate email campaigns, we'll do it all. The Aurora project is probably the best partner we have for like a full service marketing agency that's going to give you they're going to give you the ropes and they're going to execute for you. You pay for that. There are other consultants in my network that are awesome at just like, let me help you get your pitch right. We'll make sure the video touches on all the relevant points. We'll make sure the profile construction and your core message is what's going to resonate with this group of investors. And that is their specific emphasis. And that's what they work with companies on early on. We've got other partners that are specifically focused on paid media. And they're basically like, give me $5,000. Let's go get $15, $25, $50,000 worth of investments. We'll see what we can do. With a $5,000 investment, or a $5,000 injection of paid media, how much can that generate? A lot of times that's like 5, 6x. So it's like, if you're paying $5,000 for $30,000 of investments, that might be worth it to you. That might be a good return on ad spend, and that might be a strategy that you really want to pursue. And we've got partners that can help you think through that piece of it. So it really depends kind of like what you're looking for. But if you're looking for like a full service, we're gonna take you step by step through the entire thing and handhold this whole process. I think the Aurora project is the best partner that I've got, and they've got capacity to take on campaigns. I've got other ones too, if folks are interested, but that's the best one.
Okay, and again, the second question, which is basically removing that 3K buy-in, that ante you had to put in up until next week. What's the downside? Can somebody just run this, learn as they go, stumble on the way, or are you burning bridges that are going to keep you from raising in the future?
No, I think the biggest downside is just time, where it's just like, this stuff, I don't want to like undersell the like effort that goes into launching a successful campaign. It is a lot of work to like do it right. So I think that it's like, if you're just like haphazardly throwing shit at the wall and like hoping that it's all going to come together, and it's not like an explicit, focused kind of like deliverable for you to like do this, you're going to get sucked into the 20 other things that randomly pop up. All founders are trying to juggle 50 different things, and it's like, if you don't have like explicit intention that this is going to be a priority, and you're just like, oh man, like, let's just see, I think that it's best practice to just be like, no, like, we need to raise capital, this makes sense for us, and this needs to be a priority. With that said, there is nothing stopping you from putting a campaign page together, hitting up, a handful of investors and having it in your back pocket. You can go that haphazard route, but it all comes down to like calibrated expectations as to like, what are you coming to WeFunder for? If you want to raise $1 million and you have X number of dollars to bring to the table, like, we're going to have to put a little bit of work to get it. If you just want it as a back pocket option for yourself and you're pretty cool, like, you don't have expectations on like, I need to get, it's $1 million or bust. It's like, hey, I think I could like scrum up like 50, 60, 70K from friends and family and bring it all. And if WeFunder orchestrates it and makes it easy for me, I'm super stoked. Like, that's another viable option. So it really depends on your expectations and kind of levels of interest to maximize what might be possible.
Yeah, but fundraising takes a lot of time, no matter what you do with it, unless you just got a rich uncle that really loves you. So
exactly.
Have you ever done kind of a side-by-side of just on average, the amount of hours per dollar that works out from a WeFunder investment campaign versus just going out and finding angels or early seed investors?
Well, to your point about the rich uncle, if you've had a successful exit in the past and you had prior investors and you can make a few phone calls and fill up that round in a week or two, go for it. That's just not WeFunder's not the right fit for that type of company. They don't need a platform like this. I think it's impossible to come up with like a broad stroke dollar per hour dynamic, but I will say that most of the founders I've spoken with said that they prefer the process and the execution of WeFunder comparatively to angels, because I think a lot of times with angel groups, you just get like, you're just getting like tossed around, and it's like random people coming into the mix, asking random, and it's just like this strung out process for a check, where this is a little bit more kind of like streamlined, where it's just like, here's the page, here are the terms that you can participate or not. And it's like, you give that open option. It's a little bit more simplistic, and there's a little bit less like kind of, being toyed around. But that's just anecdotal qualitative stuff. I would love to have, like WeFunder explode and we hire somebody that actually dives into that and like really, really takes like a scientific approach. I only know it based on like probably biased perspectives of founders who like did a good executed a really well run campaign. But I do think, you know, the ease of use and the back end mechanics and all the investment contracts being managed and you just worrying about the core message and the distribution of that, you know, is a huge value.
That's great. Now we'll get you a second-year MBA student that can do a project on that. I think that'd be a great analysis.
We'll go hit up our friends at University Growth Fund.
So I see a question about best practices for investors in terms of evaluating which of the 200 opportunities to invest in.
Yeah, great question. There's so much information in these campaign pages. You know, you've got pitch decks, you've got a Q&A forum, so you can ask founders specific questions about their campaign after going through. You know, like there's a lot of content that's packed into this one page piece, and I think every investor kind of looks at it. You know, they have a different thesis, they have different things that they look at, they have different kind of points of orientation in how they evaluate a deal. So I think that, you know, just going through all of the information that's provided can give a lot of context, and then there's a forum for Q&A to have that dialogue. We also are building an investor school right now.
There's 200 deals a month. They're moving fast. If I dive into all of that stuff you just said, I'll be full-time reading stuff. I'll never have a chance to write it.
I mean, that I don't think that's true. You pick a category that you're interested in investing in, and you know, you kind of hone it in on a baseline level of filters. You know, are you looking for later stage? Are you looking for earlier stage? Are you looking for you know, high tech? Are you looking for consumer products? Are you looking for stuff in Seattle? You know, that's a great starting point. I mean, there's a campaign right now that you know, if you just type in Washington, you'll see all the deals in Washington State. There's an epic, you know, fancy bougie brewery, restaurant, cocktail place that's on the main Embarcadero in Seattle that's fundraising right now. And like, you know, it's like you can find that company by just typing in the location.
Well, I see a request from, oh, go ahead, Alex, go ahead.
Justin, I had one question. So I went to WeFunder and then went to sign up and then goals, and it says, why are you using WeFunder? And I put in raise money, offer office hours, and fix America.
Yeah.
And now one, you think I'm an investor.
Could you just send me an email offline on this? And I'd be happy to kind of like course correct and get you to the right people.
Sure.
Okay.
Do you have an
Perfect.
email address?
It's justin@wefunder.com.
Cool.
Yeah.
Thanks.
Looks like there was
I see a question from Max about the percentage of companies on WeFunder that meet their funding expectations.
Yeah, we'll start with the question above that with the just finished a successful Kickstarter campaign. With that, if you ran a successful Kickstarter campaign, it wasn't successful unless you delivered on the product. Just because you raised a bunch of money doesn't mean that you So if you raised a bunch of money on Kickstarter and then delivered on the product and they love the product, WeFunder's an awesome fit. But I talked to a lot of crowdfunding or Kickstarter Indiegogo campaigns, and it's like, oh yeah, we haven't sent the product yet. There's been delays. You hear that constantly. It's like, seems like over half of the companies that go through those platforms just have like natural delays in production and delivery. So I think that is like the kicker on like, if you delivered and you got really good reception and signals that people loved it, I think equity crowdfunding is the natural step in that process, but it kind of depends on the execution of the campaign. Then the second question, yeah. The second question, what % of companies on WeFunder meet their funding expectations? That is a very hard question to answer because most best practice is basically like my minimum is 50,000, which you have to raise 50,000 to get any on WeFunder. The max is $1 million, soon to be 5 million. And it's like expectations are on a spectrum as to like, we would love to raise $1 million, but if we could raise 500, we're going to be super stoked. Anything less than 300, we're going to consider this a failure. Anything from 500 plus, like, we're going to be really happy about, but we would love to get to 1 million. So a lot of times it's like expectations on, you know, kind of like, what is your funding expectations are on a very wide spectrum. You know, at the end of the day, it really depends on like, hey, are you getting positive signals from your network? And chances are, if that is yes, it almost is always the case where it's like like momentum translates from your efforts to our community in most cases. Most companies see a paralleled experience where it's like, yeah, I'm getting a lot of traction in my own, you know, with my own conversations, and the extent to which that is paralleled on WeFunder is pretty consistent on both ends of the spectrum. So, you know, that funding expectation, you may just find that like, it's just not quite there. You're not getting the reception that you want. And, you know, you see it across the entire spectrum. But I would say like most campaigns, you know, it's like, hey, I was able to get these investments from, you know, this group of 20 to 30 to 40 people. And, you know, that was a big win for me. And I love having this WeFunder thing available as I go and have new conversations. So, you know, this is just like a pragmatic value add in terms of its practical utility in me being able to accept investments. And for early stage companies, that's even more valuable because you're trying to get, you're kind of in this ground and pound, you're ground and pound, where it's just like we're having tons of conversations. And like, if we can convert a 25K check that's a no into a 5K check on WeFunder that's a yes from the same person, like that's a huge win. So yeah, that's a tough question. Most of the founders I talk to are like pleased with the process. Like our entire business has been driven by referrals. So, you know, we don't put $1 into like proactive marketing, and we put tons of effort into like, just like optimize the founder experience that generates referrals. That's like our entire growth strategy.
So we know from E8 that they had a deal where there was sort of a equity version and then a revenue version, right? And in the structure of that deal, they needed 25K checks. But after they got the critical mass of 25K checks, they dropped the minimum to 5K, and they raised more from the 5K checks than they raised from the 25K checks. So
I love that structure.
That 5K checks are actually more money in sum than 25K checks you can write.
And even more importantly, a 5K check is a foot in the door, and you have the opportunity to really show that investor, like, we used the money, we grew the business, you know, we're communicating well. Like those are all different important pieces of the puzzle when talking about investors. Most times that first check-in isn't the only check-in. You know, it is very common practice to lean on existing investors to double down. So presents a unique opportunity to have that at scale.
Cool, thanks so much. We're coming to the end. Is there any one last question that anyone wants to ask? Okay, not hearing any other questions. So I want to make clear for everyone that there are many, many paths that you can do to raise funding. The process of raising things through crowdfunding, there's Reg A+, there's Reg C, Reg D, 506B, 506C, about 12 of them. We did a talk earlier that I will try to get on YouTube, and the copy, the recording of this will go up on YouTube as well. So if you have questions about any of that, please send me a note. Thank you so much, Justin. This was great. Would love to work with you more on how we can build more momentum around startups getting funded. I really appreciate your efforts on this.
Yeah, thank you for listening. I appreciate the time and opportunity. I wish you all the best of luck, and I'm happy to be a resource for you. You can connect with me on LinkedIn or send me an email, and I'll connect you with someone on my team that can kind of shepherd this whole process for you.
Cool. Excellent. Thank you, Justin.
Mad love, Steve Morley, my guy.
Thank you very much.
Bye, everyone.
Thank you.
Thanks.